Welcome, everyone. I hope you're doing well this week. I am Jennifer DeVere Brody, the Faculty Director at the Center for Comparative Studies in Race and Ethnicity here at Stanford, and I'm speaking to you from the unceded lands of the Muwekma Ohlone peoples in Northern California. I want to thank Dr. Daniel Murray and Dr. Perlita Dicocheo, my staff members, for their work on this seminar, and to tell you that this event is part of a series on race, technology, and civil society, where today we're going to be discussing questions of financial technologies or FinTech, including the ways that new technologies impact the generation of wealth and access to credit, especially for people of color. Before we get started, I want to take a moment to thank our partners in the series, the Stanford Digital Civil Society Lab, the Stanford Institute on Human-Centered AI, Digital Impact, the Public Interest Technology University Network, and also a very special thank you to Scott Estrada, an alumnus of the Digital Civil Society Fellowship Program, who helped to organize the panel. Also, to let you know that our next event in the series is going to be on February 3rd, focusing on tools of combating bias in data sets and models, which will feature Timnit Gebru, Michael Hind, James Zhu, and moderated by one of the center's CCSRE, our Center for Comparative Studies in Race and Ethnicity, one of our race and tech fellows, Hong Chu. I want to introduce today's moderator. It gives me great pleasure to bring Courtney Robinson, the head of financial inclusion and public policy at Square, onto this Squares and to welcome you again. Let you know that Courtney has previously worked as a legal fellow with the Congressional Black Caucus, as well as a policy attorney for the federal legal team for the Center for Responsible Lending. And as such, she has years of experience working on questions of access to credit and economic policy matters. And we're really thrilled to have her working and introducing the panel and moderating today. So thank you, Courtney, and to each of you who's with us today.
Thank you so much, Jennifer. I appreciate that introduction. Again, thank you for bringing us together to Scott and to everyone else at the Center for Comparative Studies on race and race and ethnicity, excuse me. So part of what we want to talk about here today is how FinTech or financial technology intersects with access to credit and civil society. And when we say FinTech, what we're talking about is innovative services or products or technologies, even when they're utilized by legacy institutions that can help transform the landscape. So, you know, a Wells Fargo as a financial institution using machine learning could be utilizing FinTech as an innovative technology. It's not limited to, you know, simply Silicon Valley or the Bay Area or those enclaves that we think of as emerging technology places. It's everywhere, and it's embedded into the industry as we know it. And also when we're talking about solutions for social good or private resources that can be used for public benefit, I think it makes it pretty clear how these technologies or innovations that come out of different pockets can be helped or can potentially hurt the development of equality and equity. And part of that as well, segueing into equity versus equality, we want to make sure that we discuss taking an anti-racist approach to technology and technological policy, because I'm sure, as all of you know who are watching and listening in, simply because something is meant to equalize a playing field does not mean that it necessarily promotes equity. And with that, I do want to note that if you have any questions, you can drop them into the chat. I want to introduce our panelists who will be discussing with us today. I'm going to give you a short intro. Their longer bios will be available to you in the chat. They're very accomplished people, so make sure to take a look. We have Chi-Chi Ru from the National Consumer Law Center. I don't know if she's available yet. Say hi. We have Kelly Cochran from FinRegLab. And we have Fabrice from the Banking Policy Institute. Hi, everyone. It's good to see you. Okay. So now that I see that everyone is available and ready to get into this discussion, I wanted to start off with an introductory question for each panelist that will not only give a lay of the land for what we want to talk about, but also highlights each of their areas of expertise so you can get an idea of where their background lies when we talk about this intersection of FinTech and innovative solutions. So Chi, if you don't mind, up first, would you give us some background on consumer credit scoring, what it is, how it came from, what it is overall, and how its potential as an equalizing technology has borne out since its creation?
Thanks so much, Courtney, and thank you to Scott Estrada for putting this together, and the Center for Comparative Studies in Race and Ethnicity for having this panel. I really appreciate it. So I'd like to talk about credit scoring as a cautionary tale about FinTech. You know, back when credit scoring was developed and took off, late 80s, 1990s, it was the FinTech, right? It was the bright, shiny, powerful, data-driven, algorithm, big word kind of technology that would make things cheaper, faster, and fairer, because it was supposed to take that human subjective element out of lending, take a credit report, which is a longer document, and the lender could bring his or her own biases and interpretations into interpreting that credit report. It was supposed to take that subjective element out and spit out a neutral, objective 3-digit code based on formulas to tell the lender about the consumer's creditworthiness. And it was an improvement because it's better than subjective evaluation. It doesn't have those implicit or often explicit biases that human beings bring to credit evaluation. But we started seeing late 90s, 2000s, you know, this past decade, study after study after study showing that credit scores for Black and Latinx consumers were lower, significantly lower as a group than white consumers. And, you know, I've been doing this for almost 20 years now. I started working on credit reporting issues in 2006, so almost 15 years. And, you know, I see these studies and like, what's going on here? Credit scores are supposed to be objective. They don't have any racial bias. What's going on? And I finally started to understand what was going on because, you know, I started learning about things like the racial wealth gap and structural racism and how equality frameworks differ from equity frameworks. And so credit scoring is using an equality framework. But the problem is not everybody starts from the same place. The playing field wasn't level. You can't have a level playing field when you're talking about centuries of slavery and decades of intentional, outright, harsh Jim Crow discrimination. Things like redlining promoted by the federal government. Things like the fact that Blacks and other minorities were shut out of the benefits of the GI Bill, which created the middle-class wealth of the Levitt towns and suburbia. I mean, if you have whole population shut out of that gets reflected in their financial status. And so that's why you see the racial wealth gap. A huge part of that is housing, and a huge part of that gap in housing has to do with past discrimination. And the racial wealth gap affects credit scores, because if you think about it, if you have 170,000 in assets, it's a lot easier to weather 6 or 10 months of COVID-19 related unemployment than it is if you only have 17,000. And there's different statistics bouncing around, but you know, the magnitude is usually similar. And so you hit a rough financial patch without assets, the bills go unpaid, that shows up on the credit score, shows up on the credit report, shows up on the credit score. And you know, that makes sense. Credit scores, if they were measuring as a measuring tool, reflect the inequities in the society, past and present. I mean, we know, for example, that Black and brown folks are subject to racist policing, and that affects them financially. And so from an equity point of view, simply measuring it objectively isn't enough, because that will just entrench and perpetuate the inequality. And my concern is that other FinTech, new algorithms, machine learning, AI, will do the same thing unless we focus on not letting history repeat itself.
Thank you, Chi. I think that is a great background and segues pretty well into part of what I wanted to tap Fabrice and discuss, which is the promises of FinTech and financial technology and its potential for positive impact on generational wealth, as Chi brought up, for those who have historically not had that privilege and have been locked out for the various reasons that she highlighted. So what are your thoughts on policy as a tool for wealth creation, and how does that tie into innovative technologies?
Sorry, I had to make sure I wasn't on mute. Thank you very much for the question, and thanks to the team for this fantastic invitation. Hope everybody's staying safe. I think the direct answer to your question is, absolutely there's a linkage, right, between having a supportive policy environment that reflects what's going on, but also one that really reflects a vision for where you want things to go. Obviously, when it comes to financial inclusion, as we look to that future state, there's a direct link between a positive and supportive policy environment and wealth creation. You have to have the right mix of policies in order to have that proper outcome, and that right mix of policies will be a foundation for success. Just as the same way the counter is also accurate, right? If you have the wrong mix of policies, you can have a situation where you have severe impediments to the broad adoption and scaling of financial inclusion and tools that promote financial inclusion. So it's critical to have these discussions. It's critical to explore these at a high level. It's not an academic exercise. These discussions, these kinds of design thinking exercises that we go through result in, proper outcomes for the financially underserved. And these things are, these are important items as a result. And so as applied to new kinds of technologies, there's a lot of uncertainty, I think, that we'll explore today about the regulatory environment for the development and deployment of these tools ultimately. But I think what matters is being intentional about, again, the design and deployment of these tools to ensure that, as our colleague Chi referenced, a lot of the mistakes of the past are not repeated. I think that's really what's critical. Is that, those that are thinking about these things deeply, those that are having these design discussions in the non-government sector, understand what the government has in mind in terms of the policy goals that are necessary. And today, we're talking about financial inclusion. So keeping that financial inclusion at the front of mind as they're, again, designing these tools and systems before they deploy them. Again, being intentional about creating these tools, the use of big data for AI, credit underwriting analysis, the discussions about how to properly calibrate the use of consumer data for the kind of open banking discussion that's underway. Also exactly how to properly calibrate the regulatory environment for the use of the tools themselves, for AI in credit underwriting. These are all kind of outstanding conversations, but all of them, at their foundation, if we kind of have a true north of financial inclusion as a way to proceed, and I think a lot of the people who are having these discussions certainly do. I think that's a big kind of raison d'etre, if you will, of all of the FinTech technologies. At least let the participants tell it. I think that, we'll get to a good place here, but it's going to take a lot of hard work and a lot of open and transparent discussions like this one to get us there. But it's absolutely a one-to-one correlation about having a supportive policy environment and a proper set of outcomes in terms of deeper and broader financial inclusion. So I think what a great question, and very excited about this conversation today as a result.
Thank you, Fabrice. So in going into some of that intentionality and how we react on the policy front and the legislative front when it comes to touching on these issues, how the public sector fits in, Kelly, would you be able to give us a broad lay of the land of some of the fair lending and anti-discrimination laws that are in play in financial technology and discuss how they address outright discrimination, but also disparate impact?
Sure. And thanks to everyone who's been involved in putting this together. I'm really looking forward to the conversation. So it's good to be here. So there are a number of consumer financial protection laws that apply to credit underwriting and credit scoring in different ways, and they apply different types of protections. But the ones that focus primarily on fair lending are the Fair Housing Act and the Equal Credit Opportunity Act. And both of them are focusing on protected class characteristics, so things like race, color, national origin, sex, and so on. And they really have two theories under which discrimination can occur, and then that discrimination needs to be monitored as people are developing these models. So the first is called disparate treatment, and that is in a situation where a lender is treating someone differently based on a protected characteristic. It may not be with conscious bias, but it is based on the actual characteristic itself. The second theory is called disparate impact, and it's a more complicated analysis. It's really designed to look at practices that are facially neutral, but they have a disproportionate negative impact on a protected group. And the law says that in those situations, a lender can only use the practice if, first of all, it is necessary to achieve a legitimate business necessity, and that there is not an alternative practice that would reasonably achieve the same business objective with less negative impact on the protected group. So that's a really important concept because it goes beyond just saying scoring models must be facially neutral, but also thinking about what's the practical impact of the model on outcomes. And are there alternative ways, whether it's alternative variable or formulas, that can still predict credit risk, default risk, which both the lender wants and the consumer wants, because not being able to repay a loan has negative impacts for the consumer as well. But are there alternatives that can do a better job and have less of a negative impact? So that's a key concept, and it's one that's not present in every area where we're seeing data and algorithms being used. So it gives a framework to start these discussions, although it doesn't necessarily answer every single question.
Absolutely. And thank you for highlighting those differences. I think that goes back into what the other panelists alongside you highlighted when we talk about the intention and the execution, and how equality does not always turn into equity. And sort of still going off of that theme, I want to ask Chi-Chi, how does credit scoring fit into the question of economic equity, sort of going off of your earlier comments? And what is the difference between equality and equity in the world of credit and credit scoring?
So those are great questions. Thank you very much for raising them. And thank you for teeing up this concept of equality versus equity. So, if we hadn't had all these centuries and decades of intentional discrimination, then an equality framework would be fine. But we have, and it's reflected in so many institutions in our society, and that shows up in the credit score. And the problem is that the equality framework has been the dominant one for several decades. The thought that as long as you don't discriminate, and use protected class, then things are going to be okay. But as we see, things aren't okay. And so so for example, scoring, FICO and VantageScore, the companies that develop it, will say, we don't consider race, we don't consider gender. And, probably under the Equal Credit Opportunity Act, if you put race in the scoring models, you might have a problem. And so the problem is, how do you then move from that equality framework to an equity framework? And given that you're not supposed to put protected status into the scoring models, well, to follow up on what Kelly said, the disparate impact analysis does give you some options. So The third part of the test that she talked about, the less discriminatory alternative, is really important because there is a lot of work going on about alternative data and alternative cash flow, which actually her organization is the one in the forefront. So I kind of feel weird talking about it, but FinRegLab did some really great work looking at, for example, cash flow underwriting. The idea that instead of looking at your credit report and whether 2 years ago you missed some payments because you got sick, you look at what's in your bank account right now and the inflows and the outflows and how you manage money right now and whether you have enough money to take on new debt and make those payments. And is there going to be some racial disparities there? Absolutely, because anything financial, you're going to find some racial disparities. Is it going to be less? There's some pretty good data in their reports that it may be that less discriminatory alternative. So, but we got to be careful because, first of all, there are practices that do create racial disparities, even in cash flow. One of them is overdrafts. Overdrafts, they disproportionately affect Black and brown consumers. They drive people out of the banking system. There's so many unfair practices. So, that's, the devil is in the details. That's my mantra. And alternative data and FinTech could be a force for good in reducing racial disparities, but it could just make it worse without that intentionality that Fabrice talked about. That's so important. We need to keep our eyes on that North Star of equity, because an equality framework will just perpetuate the problems we see now.
Thank you, Chi-Chi. And I think, being mindful about not exasperating these gaps is something that should be, in my opinion, top of mind when we're talking about the public sphere and what the role of government is in some of this and stepping in. And I think that it gets in a little bit to the legal and regulatory framework around these issues and how it fits into, or I'll say it the other way around, how do these new and emergent technologies fit or wedge into the existing financial, regulatory, and legal framework, or the technological one. I know that during my brief time as a counsel on the House Financial Services Committee, that's when all of this emergent technology was sort of bubbling up, and there are lots of differing opinions on how our current regulatory system should fit over those technologies or innovations in order to maintain, I would say maintain equity, but we know that that's always a North Star that we're striving to, but make sure that we do not negatively impact those who need these innovations the most. And then also everyone is playing by the same rules. So with all of that intro, I would like to ask Kelly, what are your opinions or thoughts on the current legal and regulatory framework for FinTech and or finance in general, and how that applies to emerging technologies?
Sure. Well, a couple of things that I think are important here. First, as I talked about, I think the fact that we do have a framework to start these discussions is really important. There are other countries where in the lending space that isn't necessarily true, and there are other sectors, even in the US, where that isn't true, where there isn't a framework that is focusing and kind of taking people through these steps and really forcing them to think about the impacts of the data, the technologies, the other market practices. So that's an important piece. And like I said, it goes beyond kind of formal blindness to talk about things like what are the practical impacts, where are there alternatives, thinking about the underlying disparities that are driving some of these outcomes, and are there ways to make sure that those underlying disparities are minimized in the course of assessing credit risk and other things. Another thing that's important is that the framework looks both at outcomes and kind of inputs, and the debate and structure as between those two sides of things it's complicated, and not everyone agrees about how it works, but I think the focus on both sides of that is important. And then there is also a broader set of consumer protection laws that also apply in this space that go to things like accuracy. and reliability of the data. They go to transparency, what the consumer understands about what data is being used and how it's being used. When they've been negatively affected by a decision, what do they understand about it and how can they follow up on it? Privacy and various other things that are also important to this broader practice. So there's a lot to work with here. I think one of the challenges, though, is that many elements of this have been in existence for 40, 50 years. The technology is changing, the markets are changing, the players are changing. And there are definitely places where we need to continue to think about how those frameworks are really applying in the modern environment, how we can refine them, make them stronger and make them better as, you know, the characters and all of these pieces are moving. So just to name a couple of things that I think are really important. I mean, one, there are still debates about how you apply this framework, how disparate impact works in practice. The Department of Housing and Urban Development recently changed its rules and has caused a great deal of concern that they have made the disparate impact analysis for housing under the Fair Housing Act extraordinarily hard to apply in practice. So there are concerns about how it applies on the ground today. And in the broader academic and computer science world, we're seeing an explosion of ideas about other ways that you could be measuring fairness and equality. And so there's a question, you know, debate about, are these exactly the right tools? Are there better tools? How do we reconcile multiple tests and theories for what is equal when you can't necessarily satisfy all of the tests at the same time? What's the most important? A second set of questions is about gaps in kind of application and monitoring. Because of the way the financial system is structured, many of these laws will apply across the board to lenders, but lenders may be subject to much different levels of scrutiny by regulators as to how they're actually applying. And so in the bank context, or with lenders that are subject to kind of continuing ongoing supervision, even if they are non-bank, they will be expected to do compliance reviews of disparate impact on an ongoing basis. Lenders who are less closely monitored may wait for something to go wrong before they start to fix it. And so you have a huge number of problems there. There are other ways in which the data flows that are supporting this. There are other places where some of those laws, there are all sorts of multiplying questions about who's covered, how does it work as new types of data transfers evolve, and so on. So there are issues there. And then the last questions are with regard to machine learning and alternative data. These technologies are new, these data sources are untested. So they potentially raise additional questions, both kind of technical and process-wise, about how we manage those questions and how we apply the kind of familiar tests to models that, for instance, are far more complex than what lenders have traditionally used in credit scoring and credit underwriting. So, you know, it's a framework that has a lot of robustness, but the need to continue to refine it and strengthen it as things change around it is definitely, I think, attracting a lot of attention right now because there's so much in motion.
Absolutely. I think coming out of that and talking about emergent technologies, machine learning, and how that's moving at a pace, I think, even faster than regulatory and legislative frameworks can keep up with it. Fabrice, could you touch a bit on artificial intelligence and machine learning? Give us some background and how that's been utilized in the spaces that our other panelists have spoken about, and talk about how they can be used to drive equity, and perhaps what are some of the concerns with those same technologies?
Thank you. Yeah, I think there is great opportunity here, but you know, as with any tool, instead of tools, you know what they say about Lamborghini. It's not the Lamborghini itself that's the danger. It's, you know, the kind of operating environment and the driver as well that could lead to some outcomes that are unfavorable. And so I think that, you know, that's kind of how we look at some of these tools and the AI tools in particular. A lot of great promise, but, you know, given the nature of it, especially, you know, when it comes to machine learning tools, you know, from my understanding, you know, the more predictive the model, it's also possible that the less transparency is created in terms of a model output. So you do have this kind of push and pull when you talk about machine learning tools. There's that trade-off between kind of transparency and the precision of the prediction, which is really what it's about. It's about improving the predictive nature of the tools available to those that are extending credit, so as to ensure that more people can have access to credit. I think, the current system that we have often leaves far too many people out in the cold. Kind of this, traditional credit scoring model leaves those with limited credit histories, such as young consumers, immigrants, a lot of people of color, given some of historic exclusion that has taken place there. What we have today is a system that leaves a lot of people outside of the credit net. And so I think that, there are those in the financial services industry that are inclined to find new ways to better serve this underserved segment of the population. It provides for more financial inclusion at scale. But I think that, there are extant concerns in, the discussions around AI that also are applicable to the development and utilization of those tools in the financial services frameworks as well. So you have the discussion around bias and controlling for bias and ensuring that, again, the model that's applied to a particular set of data, that first of all, the training data itself is sourced in a way that is sensitive to the need to ensure that disparate impacts don't occur, that is compliant with ensuring that, protected classes were not targeted there. Also ensuring to the transparency topic that the decision that the machine recommends, if you will, is explainable. There are regulatory requirements that state that, you need to be able to explain a credit decision. And so, financial services firms are having to wrestle with that and ensuring that, again, at times an esoteric process can result in something that's explainable and transparent, not only for the development of the products, but also for compliance purposes as well, and ensuring that consumers are protected. You obviously, and some of my colleagues have touched upon it, you have these disparate impact concerns that are extant as well, that have to be constantly monitored in a vigilant fashion, much the same way they are today, by dedicated teams of professionals who really understand equal credit opportunity, and ensuring that the design and deployment of these products are in compliance with these incredibly important laws. But you also have other issues, such as the governance of model risk. And how exactly to ensure that teams at financial institutions are, again, able to pinpoint, the weightings in which the model kind of made its decision, what the decision rested upon, and really just generally understanding that a lot of these models are dynamic and not static, and how to adjust things like model risk management, which comes out of a couple of regulatory agencies, is applied by, for example, folks that I work for at depository institutions, as opposed to how that, let's say, regulatory approach is employed for non-depository financial institutions. There is a bit of a divergence there in terms of the regulation as applied to depository institutions that could potentially use these tools at scale, and those that are non-banks that are currently using and deploying some of those tools. So, I think, what matters in this discussion especially is the broadening of the financial net, ensuring that more borrowers are able to come in and, access the funds that they need to ensure that they and their families have what they need. I think in order to ensure that that goal is met, and met in a way that scales properly, I think there are some outstanding questions about regulatory transparency that need to be addressed and explained. A little AI joke there for you, to participants in the banking sector and non-banking sector. Again, it's a broad set of stakeholders that are thinking through these important questions. I think that there needs to be some conversations had with policymakers and regulators about, again, ensuring that this conversation that we're having today is reflected in current rule and practice at the regulatory agencies, especially, so that stakeholders have the same sheet of music that they're reading from in order to, again, design compliant tools to deploy at scale. So I think, the jury's out on the scaled up delivery of these tools, but I think that what we know for sure at this point is that the status quo of having so many people left out in terms of access to credit is unacceptable. And I think that there are a lot of professionals at banks, but also at non-banks that are looking into how to crack this nut. And I think that proper and robust dialogue between industry stakeholders and the regulators and the public policy makers is going to be required to bring forward an environment that promotes the deployment of these tools in a way that's responsible. So, it's kind of a TBD, but, I can tell you firsthand that, there are professionals at these institutions working on these things every day, trying to, really calibrate it properly and responsibly. And I think that that's kind of where this discussion has to go, is how to move to that future state in a way that's responsible, that meets the goals here, which is to broaden that credit net.
Thank you, Fabrice. And actually, in the midst of some of this discussion, we had a question come in from our audience that I think is pretty good and related to what you all have been talking about, and definitely have some background in. So Dave noted that much of FinTech is not directly about deploying credit, but most FinTechs deploying operational products like checking, payments, or debit products. And yet there is, as he notes, a substantial risk of FinTech being problematic. And here's the highlighted portion. Would it not be important to note the shift from local credit bureaus who aggregated good history for day-to-day activities of the average Americans, such as paying their electric bill, to national credit bureaus who mostly only aggregate negative payment information? So that shift of taking the positive repayment habits of everyday things like utilities against, the negative credit history for other forms of non-repayment. So if you guys, I would say I would go to Chi-Chi, if you could talk about that a bit, and the different forms of data that are being used. And I think also that ties into how some of our previous discussion about how things that are meant for good and equalization can be utilized in different ways when they're actually deployed in practice. So Chi-Chi, if you don't mind going into that, and I can repeat anything that you need me to.
Okay, well, yes, that was a long question. It's a good thing it's in Zoom and I can
Yes.
see. So
Technology.
A few aspects. First of all, great points about, the fact that obviously FinTech isn't limited to credit granting at all, but is in a whole different aspects of financial services and products. That the fact that people know about their credit scores and credit reports and the role they play, it is a function of the Fair Credit Reporting Act, and how consumers, now the Fair Credit Reporting Act is actually a very broad statute. It does govern more than just credit reports and credit scores. So things like, screening for bank deposit accounts, i.e. check systems, early warning, that's covered. Even information databases used for employment and tenant screening are also covered. However, Fair Credit Reporting Act only requires disclosure of credit scores and not other types of risk scores. And so we know there's a whole body of tenant screening and employment scores that don't have what Fabrice was talking about, an entire regulatory structure, supervisory personnel going in and saying, does this model actually predict anything? There are these tenant screening scores that tell a landlord whether someone's going to be a good tenant or not, and we don't even know if they mean anything. So FinTech goes way beyond that. On the specific issue of reporting other information to the credit bureaus, or other information and other databases, this is the whole issue of alternative data. And my mantra is, and devil's in the detail. It depends on what data and how it's used. So electric bills, electric and gas bills are a special category because of the fact that they are natural monopolies and they are heavily regulated at the state level, and there are all sorts of quirks. I like to say I live in Massachusetts. It gets darn cold here in January. We rack up $300-400 electric bills. Low-income consumers struggle with those. They may be a month or two late, but you get to May, weather gets warmer, and those bills become more manageable. And so there are some serious downsides and risks of what's called full file gas and electric utility reporting. Those same concerns maybe don't exist with other types of payment obligations that are similar. Cell phone bills, they're just not regulated, they're not a monopoly. Cable bills. Rent reporting, usually rent reporting is seen as a potential promising type of alternative data. Right now, because of the pandemic, I'd worry a little bit about it. We're about to see a massive eviction wave. So, cash flow, the way it's being currently piloted, just the credits and the debits and the balances can be okay. But then, people can start looking at, well, where did you shop? Raises all sorts of privacy concerns. Or it could be used for things like, we know you get paid on the 15th, so we're going to come in and grab that money, and that's how we're going to lend. And by the way, I do want to make one important point here, because we're talking about access to credit and expanding it. It's got to be access to affordable, fairly structured, fairly priced credit that's used for helpful purposes, because high cost credit with onerous terms doesn't help anyone, and it certainly doesn't help low and moderate income consumers.
Thank you, Chi-Chi. I didn't know, Kelly or Fabrice, did either one of you want to expound? Kelly?
Sure. Yeah, I might jump in to talk a little bit more about some of the data source questions too. So the traditional credit reporting system, most of what is there is payment history on other credit. So there's a fundamental problem that if you don't already have credit, there's a bit of a catch-22 that you may not be in the system at all. And there are about 50 million US adults, we think, that are not able to be scored using traditional models right now because they don't have enough of that traditional history. But the second thing is that because it's primarily focused on credit and credit history, it's primarily focused on expense side, and it only shows you part of those expenses. So things like rent and utility and other recurring payments potentially tell you a lot about how the consumer is managing their finances and kind of how much capacity they potentially have. So that's why they're potentially useful, although as Chi-Chi says, there can be some really complicating factors about different patterns and how models might treat those patterns. If they treat every single case of someone being late exactly the same, that rate starts to raise additional questions about whether that's really properly calibrated. What we have been looking at with cash flow data was looking largely at bank transaction account data. That can show you the expense side, but it also shows you a lot about income flows and how the consumer or the household is managing the balance between the two things. So I think one of the things that Chi-Chi talked about is the kind of systemic issue with the traditional reporting and scoring system, because it is potentially influenced, and households' payment patterns are influenced by income and if they have assets or wealth to fall back on in emergencies and other things. But the other thing is it just gives you actually a fairly narrow slice of the consumer's overall finances. And so that's why, some of these innovations in data in terms of starting to look at a broader set of questions could be really helpful, because you get a much clearer picture of what's really happening with the consumer, and do they have the capacity to manage the credit and repay, and those kinds of questions. So I think what we're seeing is that there's a much broader set of data sources, and that there are fintechs and kind of new players and traditional players in payments and other places where that data may be able to transfer over to the credit side and provide additional insight that would then help consumers and even small businesses be able to kind of access these funds to help bridge short-term gaps and to build their own capacity over time through home ownership, through education loans, those kinds of questions. So I think there is, one of the things we're seeing is that the credit world and the broader financial services world are really interconnected, and that we may be able to start using data in a different way between those two systems. But for all the reasons we talked about, we have to be careful about how we do it and really think through the implications, both in terms of what are the lending impacts, what are the privacy impacts, how do you make sure the consumer understands what's happening, and all of these questions that we've been talking about. But the data interest and the fact that we have access to digital information that can be analyzed, through more efficient processes, potentially does have, real benefits for inclusion if we can do it right. So.
Thank you, Kelly. And I think in talking about the extension of credit and how these other things tie into it and how we can try to improve the system and how it's also been hindered by some of these ideas, we can tie it back to the broader questions that we've been discussing in this panel. Like, how does this affect equity overall? How do these things, when we're talking about alternative data sources or assessing someone's ability to repay something, how that affects overall racial equality and equity? Could you all go into how that even ties back to things like who gets jobs, or like Chi touched on, who gets a mortgage, and how these parameters that we set around what we use to evaluate creditworthiness affect all other aspects of someone's life? I don't know if anybody wants to start. Kelly,
I'll just say one additional thing. I think credit does two things, right? One is it helps manage short-term gaps, in between income and expenses. And at a time like this, short-term emergency management is really important, right? And it not only affects individual households who are dealing with the downturn and with the pandemic, but it potentially affects the economic recovery for the country as a whole. And so, at a time where we're really concerned about equity effects from the pandemic and the downturn, that's an important consideration. But the other thing is that it does build long-term capacity, potentially wealth building, through the things that we talked about: education, home ownership. And because for small businesses in particular kind of entrepreneurs, a lot of times lenders may look at their personal scores when they're underwriting, even for business credit. So there's crossover between these two systems in a way that's usually important. And we know that small business ownership can be a really important path to wealth building and to community building. And so it's all kind of interrelated here. So those are really important aspects of it both. And I think I kind of mentioned small business, but didn't explain it very well. So maybe that's helpful.
So I would just tackle the fact that credit reports and credit scores are often used for non-credit, important non-credit aspects of life, sort of going beyond the issue of access to credit now. We know about half of employers use credit reports for at least some of the job positions for which they're hiring. Insurance companies use specialized credit scores to determine access and rates for homeowners and auto insurance. Even the Department of Homeland Security uses credit reports and credit scores as part of the public charge rule for immigration purposes. So there has been a lot of what our allies at DEMOS call mission creep with credit reports and credit scores. And what it is this narrative that has occurred, the idea that credit scores and reports are somehow reflective of a person's responsibility or moral character, when that's just not true. When we know the vast majority of times when someone's not able to pay a bill, it's because they don't have money. And they're going through financial distress. This whole pandemic is actually a good example because, the initial data is that credit scores are holding up and bills are being paid. And you know why? It's because people got $600 a week in federal unemployment benefits and a stimulus check, and they were able to pay their bills. And credit scores are actually really blunt. Someone with a 600 credit score, which is considered, subprime, has an 80% chance of defaulting. So there's actually 80% of people who would do okay, even though they have a mark on their credit history. And so one of the things we've advocated for is to stop the mission creep, that credit reports and scores shouldn't be used for important things like employment. Rental housing, a lot of landlords use it. And that at least the problems inherent in scoring and the thorny issues that we've been talking about be limited to credit.
Absolutely. And I think, even Chi and Kelly, when you touched a bit upon how your personal or individual consumer credit score can be used to make creditworthiness or determinations about how you would run your small business or how you can access credit if you're a small business owner. That's even something that can inhibit the ability of people to go into entrepreneurial endeavors. And so, when we tie that all into Fabrice talking about, machine learning and how it can be utilized for different, to drive equity, or, as Kelly and Chi again talked about, how if we add in data sources or try to look at other ways to assess someone's ability to access these things without it being tied into their, instead of it being something that is indicative of merit, which I think is not fair for use of a credit score. It shouldn't determine, this is me personally, please don't impute this to anyone I've ever worked for, but whether you should be employed in certain fields or do certain things or be able to, be a citizen of our nation, as Chi said, as it impacts immigration, and whether you would be considered a public charge. These things all tie in together when we're talking about race and civil society, equality and equity. I did want to note that we have a link to a survey. So post this discussion, since we are coming near time, if you guys can be sure to fill out that survey so we can make sure that we know how these discussions can continue to be useful to you. And I'm sure that that our host will say more about that. But I did want to pivot a bit and talk with Fabrice about some other financial technology issues and emergent technologies. One of those that you are all aware of is cryptocurrency. The big one is Bitcoin, but cryptocurrency in general on the rise as an emergent technology, and one that ties directly into not only our financial system here, but all over the world. And with the creation of cryptocurrency, there's also been a concurrent conversation about central bank digital currency and how these things tie together and have a positive or negative implication for financial inclusion. So I know this is a big overarching umbrella, but Fabrice, if you could give us just some background about not only crypto, but central bank digital currency and how those can be tools for financial inclusion.
No, thank you for that question. And but if I may, just a real quick redounder on a couple of things my colleagues were talking about. Just really quick, I just want to touch on, in terms of the promotion and pursuit of equity. The question of diversity in the rooms where it happens, so to speak, is critically important, right? If you have more diverse bankers, engineers, data scientists, coders, regulatory attorneys, you name it, working together to design and implement, compliant products, I think, outcomes will be improved. And so I just kind of wanted to note that critical importance of personnel diversity to these outcomes as well, because, obviously everybody's going to be as careful as they can to design these things and to comply with the law. But I think that it deserves to get stated that, the financial industry and the technology industry both have a long way to go in terms of having more diverse people at senior levels and in the rooms deploying these technologies. And, there's a lot of great literature out there about the need for diverse personnel in the development and deployment of these tools. I would encourage all of the attendees today to take a look. It's really instructive and, eye-opening stuff. So I just want to note that really quick before moving on to CBDC. So not a very smooth transition, but it is still related to financial inclusion. I think when you talk about central bank digital currencies, you're talking about an alternative form of, it's almost digital cash, if you will. So it's, it's alternative to the other kind of monies that the Federal Reserve deals with, i.e. commercial bank reserves or actual physical cash, Federal Reserve notes. CBDC, a central bank digital currency, as it's currently being explored by central banks around the world at different kind of stages of exploration, would be just another payment venue, another kind of token, another tool by which individuals and entities could transact with one another. It's just that the central bank would itself create this digital token, which would allow individuals, and the argument goes, underbanked and underserved individuals, the ability to have a very low cost to no cost digital account, if you will, directly with the federal, in our case would be the Federal Reserve, but directly with a central central bank that is issuing the digital cash, if you will, and that would promote lower costs in the system. It would promote things like affordable transfers across countries, and generally promote the development of things like digital identities, which could be helpful as people's digital footprints grow, to what we were talking about earlier, promoting the use of more alternative data, based around a digital identity. And so these are conversations which are in many respects nascent stages in places like central banks ranging from China to Japan to Australia to our very own Federal Reserve is doing a lot of great scholarship on this. And I definitely commend you to those sources, places like the Bank for International Settlements and places like our Federal Reserve Board for more information. But the argument is that having a digital account at the central bank could promote greater financial inclusion. And the policymakers and the experts are exploring what the implications are for monetary policy transmission, for financial stability, and what that might mean in a time of stress. Would having central bank digital currency promote more of a run on the bank kind of scenario? These are unanswered questions, as one of my colleagues indicated earlier when we were talking about AI and machine learning. These are newer technologies, and it's going to take some time to kind of suss out exactly the proper way to deploy these things. But these are questions which are being asked at the highest levels of financial regulatory agencies around the world and monetary policy authorities around the world. And again, the jury's out, but there are possibilities and there are challenges here. And I think that it's just another example of a different kind of technology that could potentially, if designed and deployed again responsibly, could promote more inclusion compared to what you have today. I'll just point you to a discussion that was had in the Congress this past spring about promoting low cost to no cost bank accounts for those that lack those today. And the FDIC recently put out a report about the unbanked and the underbanked. And you have nearly 1 in 5 American families that, suffer from some kind of lack of access to a traditional bank account or, some kind of financial transaction account. So there's a lot of work to be done. Things have gotten better since the time that I first started looking at that FDIC survey about 10 years ago. And traditional financial institutions are also providing some low cost options and alternatives for this market segment, but a lot more work has to be done. And the CBDC conversation is a part of that. It's not exactly Bitcoin, but definitely in the neighborhood in terms of digital money. And it's something that is being explored again at the highest levels as an alternative to the monetary instruments that are currently available to consumers today. And again, the argument here is that because of its digital nature, because of its almost an alternative digital cash, because of its kind of token aspect, it could promote broader use by folks who, for example, have adopted mobile phone technology at really high levels. So, the jury's out. Definitely no endorsement here, but just, an exploration and example of some of the innovations which are being explored for eventual deployment at scale. And so we'll have to see where it goes, but it's certainly one other example of, a really strong community of innovators trying to figure out a way forward on a number of these key and intractable financial access questions. So that's why it's important to watch where that conversation goes and see exactly what the implications would be, as I mentioned, for monetary policy, financial stability, and broader financial inclusion. So, put a pin on that one and let's all follow it closely. But it's something that's being discussed and evaluated, and we'll see where it goes.
Thank you, Fabrice. Okay, we've had a great discussion here. We're coming up at time. You guys have submitted questions as you've watched our panelists talk, and I do want to tackle one more if you all will permit me. Hopefully, Chi, Kelly, and Fabrice don't mind having to talk just a little bit more before we turn it back over. But there is one question that I think that you all can touch on briefly that came from registeredalready@gmail.com, which is a great handle that I wish that I had, but it does not belong to me. So registeredalready@gmail.com said, I agree with all the recommendations being made, but do you think there's a political will now to give the regulator more teeth because self-policing of financial technology might not yield results? I see Kelly. Okay.
Yeah, I think we're at a unique moment. I mean, I think one of the things when we released the last in our series of reports about cash flow data this February, the biggest question we had was whether the market was going to move to adopt, because while it does appear to have substantial promise, it takes a lot of work to do it, to change systems, to build new models, to engineer the data flows and all those questions. And we've really seen, I think, a shift over the last month since that report came out because of the pandemic, because of the mass racial justice protests, and all of the things that the country has been through. I think there's much more sensitivity to the structural inequality issues that are shaping the financial system, and then in turn shaping broader economic and societal engagement. And the downturn itself is forcing financial services providers to shift off the status quo, because the regular models and the regular data don't work very well during a time of tremendous change. So I think there's a real moment to seize to get things done, because there is interest both from industry and from regulators and Congress about these questions. Now, obviously, there's a lot in motion right now. We don't know exactly how that's going to play out. There are places where regulators can do a lot with the tools they already have. The Consumer Financial Protection Bureau, for instance, is starting a rulemaking process that could settle a lot of questions about data transfers between different types of financial services providers. There are some things that only Congress can do. And I think that's more of a question at this point as to how much political will there is to get in there and get those questions settled. But I do sense a real shift in momentum over the last 8 months. And I think in general, it's towards really trying to be more thoughtful about these questions.
So if I may, first of all, I just have to remark, is this the first time we've mentioned Consumer Financial Protection Bureau this entire panel?
I think it might be.
Crazy.
The coolest agency on the New Kids block.
Yes, the most important regulator and actor and right in this space, and one that, looks like there may be some shift there. And there's a lot of good career folks who focused on this, and it's so I want to echo what Kelly said in some part, which is that there has been I think a huge shift in thinking that some of the things that I had said or advocated for that seemed kind of out there. Now there's a growing acceptance. The fact that financial institutions came out in defense of the disparate impact standard, I was blown away to see that. So I think there has been a shift, except there's also a lot of inertia in the system, and the battle will be to see if the paradigm shift can overcome the inertia. I mean, here I was all optimistic. All these banks are talking about investing in Black and brown communities and, wanting to do special purpose credit programs, which is this exception under the Equal Credit Opportunity Act, where you can actually target lending programs to underserved communities. And then just yesterday or the day before, we got this notice from this agency called the Federal Housing Finance Agency, FHFA, which is the regulator for Fannie and Mae and Freddie Mac, the big mortgage guarantors, saying that they're going to continue using classic FICO for mortgage lending. Classic FICO was built in 2004, rolled out, the year George W. Bush was reelected president and the Red Sox finally won a World Series. Classic FICO is 16 years old, and they won't even move to a FICO model that reduces the impact of medical debt, let alone a model that reduces racial disparities. And so I was like, oh my God. And I know there's some quirks and there's a reason for this, but the inertia in the system is strong. And so that more than anything, we need to, you can have new models and new data that reduces racial disparities, but some, lenders have got to use them.
Yeah, no, I totally agree with that.
Thank you so much for those answers. I hate that I see all these good questions came in. We're already over time, and I feel like we could talk about this for not just an hour, but for hours, especially as knowledgeable and invested as our panelists are. But I want to remind everyone that there's a brief survey. Please take a moment to fill it out. Link is dropped in the chat. Again, there are also resources from all of our panelists that expound upon some of the topics and ideas that they've brought up here. And also, again, wonderful questions. I want to answer them all so badly or pose them to you. But again, there will be more in these series, more to learn, more to know. Thank you again to all of our panelists, and thank you to all of the attendees. Please be sure to fill out the survey so we know what's helpful, how to improve, what you enjoyed, what you didn't. And again, thank you all for being here. Kelly, Fabrice, Chi-Chi, thank you so much for your expertise. Appreciate it.
Thank you. That was fun. Thank you.
Thank you.
Thank you.
Be safe.